You hear me talk a lot about oversupply in today's self-storage market. But let's back up a minute and take a look at exactly where we are in the real estate cycle and get some context for the conversations we're having. You know, I take it for granted that everyone understands and knows real estate cycles, but I realize not everyone does. So let's take a moment, back up, look at classical real estate cycles, where we are in the cycle, and how we can use this knowledge to benefit us. My name is Helm, and I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Self-Storage Quick Start Academy. And what I do is I support the small investor who wants to get in the self-storage business or who wants to grow their self-storage business, strategically do so in a way that creates true wealth and a fulfilling career. And the Quick Start Academy is a website with online training designed specifically for people getting in or wanting to grow their self-storage business. There's paid for training with all types of resources. There's free training. Use it to support you as you get in or grow in this fantastic self-storage business. But there is a never-ending cycle that goes on in the economy, and it goes on in real estate, and it goes on product by product, office, retail, self-storage. The cycles are always the same. Sometimes the length of time is different. But by knowing the real estate cycle and where we are in it, we can be prepared for what's coming next and know how to operate within wherever we are in the cycle. In real estate, all types, but especially self-storage, is a very local product. So talking about how much self-storage there is in the U.S. is interesting, but for the most part, very irrelevant. It is a local product, and with self-storage, it's even more than a local product. It's a micro-local product. It is a sub-market product. So what's going on in one sub-market may be totally different from what's going on in another sub-market, even in the same general market area. Now, what's going on in the market area is going to affect each of the sub-markets, but especially with self-storage, remember, it is a very sub-market product. 80 to 85% of your customers are going to come from your market area, which in general is 3 to 5 miles. 3 to 5 miles. Typically, the classical real estate cycle has 4 phases to it. I can remember when I first got into real estate business back in the early 80s, 1980 is when I first went into the business world. Interest rates were 16 to 18%. I remember later on in the 80s selling houses, and I remember when interest rates dropped from 12% to 10%. I can remember saying, man, if interest rates are at 10%, I can sell all day long. I can sell real estate all day long at 10%. Try selling real estate today with a 10% interest rate. There's cycles in the economy, and it's critical to know where you are in each of the cycles. So in a real estate cycle, generally, there's 4 phases. The first phase is recovery. The second phase is expansion. The third phase is generally called hypersupply, and the fourth phase is called recession. Every real estate cycle has these 4 phases in it. And the phases last a long time, and in real estate especially, it almost occurs like these phases are going in slow motion. And the reason is because of construction. Construction and development takes a while. So economists call that lag. So there's lag in these real estate cycles because of the time for construction. So let's take a quick look at a graph that explains the 4 phases of a real estate cycle. We'll start with recovery. Now, usually in recovery, you're coming out of a recession, so there's been very little new construction. You've got declining vacancies. So in the last recession, if you own self-storage, we were down in the mid to low 80s in our occupancy, and slowly we started increasing our occupancy. We hadn't had a price increase in a couple of years, and initially we quit giving away incentives, and then we actually had a price increase. And then at some point, and these are not clear, distinct lines, but at some point, expansion begins to take place. New product begins to hit the market. Facilities begin to expand. And that expansion and development continues to the point where all of a sudden a lot of product is beginning to hit the market. Vacancy rates are beginning to increase. Occupancy rates are going down. Incentives are now having to be offered. A lot of product is on the market, and because of the lag involved in construction, a lot of product hits the market a year and 2 years after there's already oversupply. And then what happens is, with increasing vacancy rates, all the construction going on, very often the Fed will increase the interest rate, construction begins to slow down, you'll start to notice increasing vacancies, and slowly you slide into a recession where you've got to absorb all the product out there. There's very little new construction going on, but there is 2, 3, 5 years worth of oversupply on the market that needs to be absorbed. So let's talk a little bit about these phases individually and specifically around self-storage. So we'll start with the recovery phase. So the recovery phase starts when there's been oversupply and you start all of a sudden beginning to increase your occupancy. And I can remember I owned one facility in 2008 and 2009. I know, a great time to get in business. We put a project under contract at the end of 2007. Everything hit the fan, we scrambled, we ended up closing on it right as the recession took full grip in our economy. And what happened in storage was, not many people knew a whole lot about self-storage, but in this last recession, on average, self-storage lost 6%. That's literally exactly the percentage that we went down, was 6%. So we were in the high 80s when I purchased the property, and we went down to the mid and low 80s in our occupancy rate. Now, that had an effect on us, but I'm telling you, it was a minimal effect compared to office and retail. Those sectors got hammered. Hospitality got hammered. What happens in this phase is, and same with a recession, is that you've got to really focus on your collections. The gap between economic occupancy and physical occupancy, if you're not on top of it in these two phases, can really get out of hand. But all in all, self-storage did pretty well in the last recession. Usually you'll see the Fed trying to help. They'll be reducing interest rates. They'll be doing other things to stimulate the economy. And slowly, money starts flowing again, and your occupancy rate will begin to tick up. And then at some point, you'll be in a recovery, or what's called in the real estate cycle, expansion. I remember in our market in 2010, we did a new self-storage facility. Actually, it was a conversion, but for 2 years, that was the only new self-storage product that hit the market between 2010 and 2012 in our market. And interest rates were low. We were able to borrow the money. We did a mixed-use product, and we're able to get a new one online. Leased up good. It's about what we predicted. It wasn't, robust, but it began to lease up. Then as the recovery hit in the self-storage market, expansion starts slow, recovery starts slow, and then it begins to pick up speed. What happened is, in around 2012, the self-storage caught the eye of Wall Street and investors, and they saw, wow, we've been investing in hospitality, retail, apartments. Look at self-storage. It did real well during the recession. Self-storage and student housing made their name during the last recession. And all of a sudden, when the expansion hit, all of this money started flowing into the self-storage sector. What happened is prices started going up, cap rates started going down, and development and construction started happening. 2012, December 2012, that was the last time we were able to buy an existing facility that was already stabilized, put it into service, and have it start generating the returns that we need as small investors. From then on, as during the expansion and recovery of the last real estate cycle, we had to do value add. Even to this day, we're having to do value add plays because of the pricing of this product. So what happens is, in the expansion phase, there is new construction and expansions of existing self-storage start happening because there is a pent-up demand that needs to be met. And at some magical point, what will happen is that construction keeps coming on because of the lag involved in a real estate cycle. It all of a sudden will tip, and there will start to be oversupply. It's called hypersupply in classical economics. Now, I can remember 2 years ago writing articles talking about there is no reason today in self-storage to get into oversupply. Why? Because we have the data analytics, and anybody from a REIT down to a player like us can look and find out exactly how much square feet of self-storage there is in most any given sub-market in the country, and there's no reason for us to add more product in a market that's at equilibrium or above. Well, I get that that was a pipe dream, and I get that lag is involved, but at some point it goes into oversupply. In most markets today, that is where we are, is in oversupply. If you happen to be in a market that's not there yet, know that that's coming and just be aware of it. So in an oversupply market, that doesn't mean you can't get in self-storage. It just means you've got to be very diligent and be very careful where you go and how much square footage you're bringing on. And it's critical you know what's in the pipeline in front of you that's going to be hitting the market. Again, there's tools out there that can help you. Not trying to sell it, but I can do, in most markets, preliminary market studies that will give you a good overview. It's not exact, but it will give you a good overview. We charge $350 for that, and it doesn't replace a feasibility report. It just gives you a glimpse into that sub-market where your product is. Now, at some point, so much product hits the market, occupancy rates go down, you start having to reduce your rents, and it'll slide into, and again, not a clear date, it doesn't happen at 12 a.m. on January 2nd, but it happens sub-market by sub-market. It'll go into a recession where you have declining occupancy rates, especially in recession. Interest rates are high. Interest rates are high because the Fed has been trying to slow down new construction. And the higher the interest rate, it also has an impact on existing self-storage owners as interest rates go up. So in many cases, it's a double whammy. Higher interest rates, lower income from lower occupancy rates. Some people slide into negative cash flow. Most people in self-storage don't. They may be earning less money, but you've got to ride out that low time. Now, what's interesting is, in every single sector, in every single phase of the real estate cycle, there's opportunity. In reality, no phase is any better than the other phase. We think expansion and recovery are great. Not really. Most of the companies that are on the S&P 500 are companies that were started during recessions. Recessions create untold opportunities for savvy strategic investors, which is what we are. My whole goal is to have us, the small investor in the self-storage space, be strategic in what we're doing. It's critical that we know where we are in the real estate cycle, because in every phase of the real estate cycle, you do different things and you prepare for what's coming up next. So how does that look on the court? Well, it looks like right now in oversupply, or going into oversupply if you're not already there, you're very careful where you open facilities, where you expand facilities. You go in markets where, in sub-markets where the per capita per square foot is low, there the population is growing, and there's not a lot of product ahead of you in the pipeline. Sometimes even people doing feasibility reports will underwrite a facility at 90%, 92%, 88%. Why? Because that facility's been at 95% for 3 or 4 years. Don't do that. How it looks on the court is you underwrite your facilities at 85%. You may put in no price increase the first year or two. And then even though this facility's been experiencing 6% over the last 5 or 6 years, you underwrite it at maybe flat year 1 and 2 and only 3% from then on. And your operating expenses go up every year. If you know what's coming next, you know what to do in where you are in the real estate cycle. And be prepared when we go into, quote, recession, and it will happen, and recessions aren't bad, recessions just are, and there's a lot of opportunity in recessions. Be prepared to take advantage of product hitting the market. What will happen is many people have overpaid during the expansion. Their loans are coming due. The bank may or may not renew their loan because their value has gone down. It's worth less than when they bought it, and they're going to try to unload those. Be prepared to be able to buy and put a lot of product into service during the recession. Each cycle offers its own unique opportunity. As investors and business owners, we need to know where we are and know how to take advantage of it. Don't be scared of any particular cycle. Just know what they are and know how to operate within them. And you will create true wealth and a very fulfilling career in self-storage. For the small investor, this is absolutely the best product to be in as we travel through all of the phases of a real estate cycle. So I look forward to being with you next week. My name's Mark Helm. I'm the author of Creating Wealth Through Self-Storage. And if you're not using the Storage World Analyzer to project your future cash flows as we move through the real estate cycles, explore it, especially if you're not good with Excel or you make a lot of mistakes in Excel. Storage World Analyzer is the only cloud-based financial analysis tool specifically designed for the self-storage industry. I look forward to being with you next week, and I'll see you then, and happy sailing as you go through the real estate cycles in the self-storage business.